so much for joining. This is the second video to give an introduction to cash flow statements. In cash flow statement video number 1, we talked about CFO. We talked about the direct and indirect method to create your cash flow statement from operations. And I gave you a high-level overview what cash flow statement from operations, cash flow statement from investing, and cash flow statement from financing means. What I would like to do, just to complete the topic, I would like to show you how a cash flow statement for financing and investing could look like. As we talked earlier, just to quickly recap, CFO indirect starts with net income, then does certain adjustments, depreciation, gain on sale, increase accounts receivables, increase inventory, decrease decrease prepaid expenses, increase accounts payables, increase salary and wage payable, and then decreased interest payable, income tax payable, and these are more or less, if you look here, these are balance sheet items where you compare two dates and then you see whether this corresponds to a cash inflow or cash outflow. Yeah, this is a non-cash item, and here gain on sale or loss, cash outflow or inflow, which you need to adjust, and basically all those items, taxes payable, interest payable here and here. These are balance sheet items to adjust between accrual accounting and cash accounting. I have recorded another video on net working capital. You should definitely have a look there, because if you increase your inventory, then more cash is tied up in your inventory, less cash is available. So your CFO would decrease for accounts receivable, similar fashion for accounts payables, the opposite direction. So have a look that you really understand what an increase, decrease of each item means and whether this corresponds to a positive or a negative cash flow. The direct method is similar to what we do for cash flow from investing and cash flow from financing. So if we look at cash flow investing activities, there is only the direct only. There is no indirect method. And here, cash received from sale of equipment, cash paid for purchase of equipment, and this is really cash inflow, cash outflow. Don't confuse with this item. That's a similar item. Here you adjust from an operating perspective what is your loss or your gain on a sale. Does not need to be this item. Here it's really from an investing perspective, what came in, what come out. Here it is to adjust your net income. To translate between accrual accounting and cash accounting. This is then your net cash used for investing activities. And then if we look at cash flow from financing, here again we only have the direct method that looks directly on cash inflows and cash outflows. And here we have cash paid to retire long-term debt, cash paid to retire common stock, cash paid for dividends, and then you have net cash used for financing. Yeah, and then what you do, this one plus this one plus the CFO total is then basically your net increase or decrease in cash. And what I did another video to link the financial statement. What happens is you have your balance sheet and your cash account as a starting point, then CFO, CFI, CFF, and then you have balance sheet. Cash account. Yeah, so your cash flow statement basically reconciles your cash accounts in your balance sheet. Yeah. Again, just as an example, there are many more items to be considered. Main part here, what do you invest in equipment, in property? What is your investment? CFF is basically all the transactions between the company and the capital providers. So here, what is the money exchange between you and your debt holders? What is the money exchange between you and your shareholders? What is the relationship between you and your shareholders? Again, cash flow financing. And CFO is all about your operations. Cash received from customers, cash paid to suppliers, cash paid to employees, cash paid for interest, cash paid for taxes. Yeah, I hope you found this useful. Thanks so much for joining and talk to you later. Bye.